I'd like to bring on now. We're going to get into some of the meatier topics. That wasn't a meaty topic. I hope you found that very stimulating. I certainly did. But in terms of the nitty gritty, in terms of the deal flow, and so I'm going to bring to the stage someone I've known for a long time. He's best known as a hotel lawyer. In fact, he's written a book, The Little Blue Book Guide to Hotel Management Agreements. But Tom, you've also done hello, morning. You've also done a bit on the retail side as well in your career history, I noticed as well. So despite all that, so you have that broader depth as well. But Tom Page from CMS, I'm handing over to you.
Thank you very much, Andrew. Thank you very much. Good morning, everyone. We've got a session today that's going to be looking at sort of occupation trends in operational real estate. We've unfortunately lost one of the speakers who was originally trailed due to technical difficulties in not being able to access this platform, but I'm delighted to say that we've got with us today, first of all, Mark Clacy-Jones, who is a fund strategist for real estate at Aberdeen Standard Investments, and he's responsible for facilitating optimal fund level strategy across their global suite of funds. And with him, I've got Cedrik Lachance, who is the global head of company and sector research and a member of the executive leadership team at Green Street Advisors, who produce thought-leading research on sector-focused topics in commercial real estate. So welcome, gentlemen. Thank you very much for being here today.
Good morning. Nice to be here.
Just in terms of what we're going to cover in the half an hour we've got today, we're going to look a little bit first at the context in terms of the trends in operational real estate pre the COVID crisis, and then we're going to have a little bit of a look at the impact of the crisis on investment trends and what we can expect for the new normal going forwards. So to kick off then, we've heard obviously the initial comments with Andrew and David at CBRE this morning around the trends in operational real estate. To what extent do you agree with those comments that big institutional investors, real estate investors such as yourself and your clients were increasing their exposure to operational real estate rather than just the traditional commercial triumvirate of office, retail, logistics? And if they were, what were the drivers for that strategy? Mark, do you want to kick off first?
Yeah, sure. So, I mean, from our perspective, definitely agree with that. It's been a long time coming, trying to move the real estate industry out of the three main food groups of retail, office, industrial, into what is increasingly a large proportion of the investment universe in many markets. Obviously, the UK is a little bit behind quite a lot of other markets in terms of investment into hotels, into residential as part of a commercial portfolio. So across the vast majority of our strategies over recent years at ASI, we have been trying to increase allocation to as many of those sectors within operational real estate as we can, and in most instances largely for diversification purposes. So why would you not increase your investable universe to produce better returns, but better risk adjusted returns?
Okay, and Cedrik?
Yeah, very much agree with that. So from our perspective, we don't invest money. We write research, we provide advice basically to people. And what's been interesting, coming from a US background as a firm as well, where we've seen a movement outside of the traditional food groups of retail, office, and industrial. We're starting to see that as well in Europe now, and it's going to be to investors' benefits, of course. When I look at how we thought about the world pre-COVID, first of all, a lot of the non-traditional property sectors, which tend to be operational real estate property sectors, had better expected returns from our perspective. And what we'll talk about, we see as of today. But when you think about the institutionalization of various asset classes, there's not a lot of excess profits to be reaped out of office, industrial, or retail. In fact, in retail, of course, there was a lot of challenges brewing. It's been brewing for a long time. And a lot of investors have not sufficiently paid attention to all of these other investment asset classes on the real estate side, where the going in yields were a little bit higher, where the prospects for growth actually are a little bit better, and therefore the returns were a lot more interesting. So I put student housing in there, I put self-storage in there. A lot of the medical sector fits in there. The hotel business, not as much. The cyclicality makes it a little bit more difficult, so it's harder to opine. It's really a question of entry point very often, but there's a lot of sectors that are deemed non-traditional or operational that had a much better entry point for us from our perspective, let's say on February 1st.
Okay. And you picked up there in terms of the pricing differential and the yield differential. Do you think the yield differential between the sort of operational real estate classes versus the traditional triple net leased markets truly reflected the risk differential, or was there a mispricing there in terms of the yield differential not necessarily matching the risk differential?
In most cases, I think, first of all, I think often, and I'm going to speak outside of COVID, because within COVID, within a world where there isn't a vaccine, there are some binary events in some of the operational real estate in some very difficult environments, of course, when you think about lodging or some elements of retail and student housing for that matter. But if you think about the riskiness of various property sectors, when you look at the long life of various sectors the past 20 years, as they institutionalize, as they become accepted by investors that are, as we talked about, diversifying their portfolios, yes, the yields decline, but there is also a growing of the pie where we realize that there's a lot more consumers for these products. Sometimes it's a demographic issue on the medical side. Sometimes it's an acceptance for property sector like storage to some extent, or even student housing, which really in its current form is a fairly recent sector in terms of the quality of what's being provided to students versus what we dealt with in the old days. And as a result, there's better long-term rent growth, if you will, in these sectors than people underwrite early on. And if you can underwrite that properly, even if the yields eventually sharpen a little bit, you still have the potential for excess returns. Okay.
And in terms then, should we move on to the impact that the crisis has had? What impact do you think the crisis has had in terms of whether it's supply of new product, investment product demand, capital returns or yields on the various operational real estate classes that you look at? Mark?
Yeah, I mean, I think so. Very early in what is going to be something that plays out over many years, I think is the first thing to say. With valuation uncertainty clauses put on most assets across Europe for end of Q1 and some for end of Q2, it's really difficult to see whether what we expect to be materializing is materializing. We would be assuming that returns will be lower, that capital returns in lots of instances will be negative. And we would expect that the valuations will catch up with that during the course of this year. Beyond the initial impact, though, I think we have to be aware that potentially we are in one of the worst economic recessions for potentially 100 years, and that will have a second wave of impact, a little bit like we saw in the GFC, where there was an initial impact because of the financial crisis, and then the economic impact of that afterwards. So I think we're expecting a pretty subdued return environment for the next 2 or 3 years because of what we're currently in. But in terms of actual pricing now, very difficult to tell. Transactions obviously are much reduced from normal levels.
Cedrik, which sectors do you think will be more or less affected by this crisis?
Yeah, we've thought about that quite a bit, like all real estate investors, of course. There's really two ways to go at this. One is to think about the recession resistance of some sectors, or the cyclicality, if you will, of some sectors. And that's for what I'd call a normal recession, if there's ever been such a thing. In the normal recession, lodging, retail, office in particular get affected the most. That's where you see the most cyclicality in terms of what we think of occupancy and market rent. So that normally should translate to values, although the values don't show up immediately. The cyclicality is strongest in those sectors. And typically, you are playing more defense if you're in the student accommodation, if you're in self-storage, anything that's medical related, not surprisingly, and effectively anything that puts a roof over your head. So if you are in the PRS business in some form, in whichever country you are, it tends to be defensive. But then you put the COVID element to it, which of course changed a lot of things. It put an end effectively to the lodging business for a couple of months, for the travel industry for a couple of months. So a sector that's already at risk becomes even more at risk. Retail suffered in the same fashion. And the big surprise, of course, was something like student housing, which effectively a defensive sector historically obviously is not when you start shutting down schools and telling kids that they can go home. And you have to forgive the rent. So the nature of the cyclicality changed completely. For us, the way we look at this first is we love to take cues from the public market. The public market's pretty good at forecasting the direction of traffic. And when you look at what the public market has said on valuation, first of all, it said, don't worry about residential, or largely don't worry about residential. So far in the crisis, so if you go from the peak of the market in mid-February, you would find that the sector that's performed best in the public market is the German residential business, where share prices are flat. So look at your own portfolio, think about the values of public equities, and think about owning German real estate that's been flat since February 19th. The other sectors that have had very little decrease in asset values from a public perspective are the healthcare business and the industrial business. And when I think about what we see on the ground, the public market gets it largely right. To us, it really looks like industrial values at the top end haven't really moved. For a more run-of-the-mill property, maybe there's a few percentage points decline. The residential business is effectively unchanged in terms of value. And then you get into other sectors where on the retail side, on the office side, the public market's saying asset values are down 20%. So if you lever that up in a public security, the public security is down 30 to 40%, depending on leverage for companies. But the main point here is the public market is directionally telling you that 20% could be the decline in some of those sectors. From our perspective, our spot NAVs, which tend to be different than what the public companies publish, are already down more than 15%, 15 percentage points for the retail companies. And we've been a lot more careful elsewhere. We've made no change, for instance, and on the healthcare side, we've hardly made any changes as well on the self-storage side. On the student housing side, I should have mentioned that. Student housing obviously got hurt, both in the US and in Europe. It's fun to compare between the two because you see that the decrease in asset values share a lot of similarities, and they're around 15 percentage points. We don't think asset values should be down that much, but the public is afraid, of course, of the binary elements associated with cash flows this September and prospectively even next year. So there's some concern there that I think hurts share prices.
Okay.
Yeah, and I guess, sorry, just another point on that. I guess what we can look at, because we don't have so much on the valuation side that we can rely on right now, is the income collection. And as Cedrik says, German residential, we've got a big exposure to German residential, and we're not seeing anything happening to the values, and we're not seeing any concern on the income. Obviously, the other end of the spectrum is UK retail, and that tells you the rent collection levels that you're getting there tells you what's going to happen to the values by the end of the year, I think. Yeah,
I mean, you mentioned retail, and obviously retail was in trouble long before the COVID crisis came along, and to some extent the F&B restaurant sector was as well. We'd seen a number of groups, going into administration even before the crisis, and obviously the crisis has sent a few more at the weaker end of that spectrum into insolvency as well. Do you think, first of all, it was interesting listening to James talking about the move from sort of stuff to experiences, and first of all, do you think there's still a potential investment market for both retail and also F&B driven by that experiential market? And secondly, do you think that the big institutional investors, which have previously concentrated their sort of retail and F&B product on those fixed rent triple net leases, with upwards only rent reviews, will change their model and go to more of a variable rent pricing structure, and trade off a bit of volatility on the income for some more security for their tenants, and a longer potentially longevity of their tenants?
I think what happens when you get hits like this to the cycle is where quality really comes to the fore. So whilst retail is obviously getting an awful lot of bad press, and a lot of it is justified, not all retail is going to be shutting down forever. Not all experiential retail and leisure is going to be shut forever. But we do think the footprint of assets that are sustainable going forward will be reduced. So what we'll expect to see from a return perspective over the coming year or so is quite a big differential between good quality and poor quality. So I think that's going to play out in food and beverage, in leisure, in retail. But I think large shopping centres, for example, that are right at the top of the game, they will survive and they will do fine. It's the other end of the spectrum that you need to be concerned about, and there was probably too much of across the spectrum of quality in portfolios going into the crisis, even with the structural decline in retail that we've been seeing. Yeah, and the second point, sorry,
go ahead, Mark.
The second point was related to whether the landlords would be willing
taking on more operational risk. Yeah, I don't think they've got much choice. I think if that's the way the lease structures evolve, then the landlords will have to go along with that. In the same way that the 25-year lease with 5-year upward only rent reviews in the UK, if you look at how many there were 20 years ago and how many there are now, they're far fewer. So I think lease flexibility is something that we've been seeing as a structural trend, and I think a lot of the structural trends that we have been seeing just get speeded up by an event like COVID.
Okay. Yeah, Cedrik, do you have anything to add on that point?
Yes, just on that very final comment that Mark made, it's all about the acceleration of trends. That's the important piece here. A lot of what's occurred lately is trends that were in place that have been fast forwarded by a number of years effectively. And I don't think I've been on a panel where I haven't used the word e-commerce in the first 20 minutes in the last 3 months. So I get to finally use it. If you think about e-commerce, the acceleration of that in relations to retail is magnificent right now. It's not a good thing, of course, for retail, but to Mark's point about quality retail, there will be plenty of retail left, and it's going to be where you have good demographic in terms of population density and income, and where you provide an interesting environment, an interesting shopping experience where it's fun to go, basically, and that's not going to go away. And I'm talking post-vaccine here, but it's not going away. It's going to be very positive. Over time. In the near term, what you have, of course, is acceleration of a variety of trends. We're all going to buy more stuff online, and that is going to have negative impact on a lot of apparel retail, on a lot of run-of-the-mill retail for various goods. And because of the challenges economically, I think we're going to have to pare back the F&B offering overall within the UK. Really, frankly, globally in developed nations, you're going to see a lot less of that. When you think about what it means, since the beginning for retail, it's been a partnership in pain between the retailers and the tenants. And you see that in the rent collection, and that rent will not be collected. In many cases, it's already been forgiven. And if not, it's going to be forgiven over time. A big chunk of it will, because the retailers, and I'm talking about retailers, F&B, everything that is under a shopping center or a high street roof, is not going to have the ability to come back in business and repay these past rents. I think we're going to see shorter contracts. We're going to see a different approach to providing TIs. And an interesting development in the US is a company like Simon Property Group and Brookfield Asset Management, which are the two biggest mall owners, are starting to be involved more and more in retailer bankruptcies, where their names are circulating. They've already bought a couple of retailers over the last couple of years, and some of the most high-profile bankruptcies are right now. You see the name of an operator, and a retailer that is trying to resurface various companies that are bankrupt, including department store JCPenney. but with the support of landlords. And I don't know what it's going to mean for valuations over time. I don't think landlords should necessarily be in the business of operating or be the owner of their tenants. At the margin, of course, I'm open-minded that it's going to work out for them. But what we're seeing here is landlords doing things that they have not done in the past, in terms of being more involved financially with tenants if needed. And we're going to see changes to the lease terms. I don't think we're going to see a ton of percentage rent, for instance, but there's going to be some more flexibility that will be introduced in the contract, especially in the near term.
Okay. I should just add, if anyone watching has got any questions for the panelists, do put them in the chat on the right-hand side, and we'll see if we have time to address them. So moving on in terms of sort of the new normal, obviously we've talked a bit about the short-term impacts on various sectors from the crisis, but putting the short-term impacts aside, what do you think the sort of the more medium-term recovery outlook looks like, and what shifts in strategy are you either undertaking yourself, Mark, or recommending to your clients, Cedrik, in terms of sort of 18 months plus type investment strategy that they should be looking for?
So I mean, currently a lot of investors quite wisely are taking a wait and see attitude, which is what you'd expect in a very uncertain market. There is a lot of capital out there, but it's, I think, quite patient. So it'll wait to see what is available. In terms of kind of the main structural themes, once we get over this, what could be a 1 or 2 year very uncertain, volatile time, particularly if we get waves of increased infection, is probably, to simplify it, retail is off the menu. Office is a question mark. Who knows at the moment? But there's about how people will return to work. I think from a flexible office perspective, actually, things were starting to look a bit weak with the WeWork scenario prior to COVID, but COVID shakes up the way we work so much that perhaps that's a positive influence in the flexible office environment. Logistics, I think we see a clear benefit now and continued structural benefit from more e-commerce, as Cedrik was saying. Hotels, and I know a lot of people on the in the conference are interested in hotels. I think clearly is taking a very hard hit in the short term. I think medium term and long term that comes back, but again it shakes it up potentially. We think that there will be probably fewer trips taken from a business perspective, but they might be longer, and therefore apartment hotels might benefit. We think the budget space might see some consolidation, and again it comes back to quality. The good locations will do well because corporates that are having their travel budget squeezed are more likely to move down the chain rather than up the chain from a cost perspective. So they might also do quite well. Student accommodation, I think we believe that, again, short term with travel, there might be some quite a lot of students, international students, potentially staying at home. We don't see that being the case in the main university centres going forward. You think about places like Oxford, Cambridge, London, Edinburgh. You would expect that international student demand to still be there going forward. So I guess that's how we see the major parts of the market, and residential we see as being a strong structural trend to support residential and senior living as well with demographics.
Yeah, Cedrik?
Yeah, I agree on many fronts. So to us, the big change here is work from home, and what comes with work from home in terms of changes in patterns on office, on residential, on lodging. we've all been thrown into this experiment, and it does have limitations, right? There would be 4 of us instead of 3 of us if tech wasn't an issue on this panel. So it tells you that working from home is not always the best thing. But our numbers, something that we've been thinking about a lot, is that from probably 90% of the population that goes to the office on a daily basis today, we could see that drop to as little as 60% truly going on a daily basis. And the other 40% of the population could have some level of flexibility. In some cases, it's a day a week, and in some other cases, it will be the extreme of not having to show up at the office at all. As people reassess where they should live based on that, if I go to the office, let's say once a week, should I really live in central London, in proximity to central London, or should I move to the coast and take the train once a week, but save a fortune on housing and probably live in twice the size and everything that comes with it? Do I rethink, therefore, my residential needs? Do I rethink my office needs as an employer? And if as an employer you need a little bit less space, where do you want it? Do you want it on very, very good transportation nodes that happen to be where the trains come into town, rather than being exact on particular tube lines, because now your workforce is coming from further out? So from our perspective, work from home is a really big deal. It's going to be the continuation of a process. We're not calling for the end of the office by any means, but reducing demand for the office space, even by 1 percentage point per year versus what it was, really has a meaningful impact to rents, to occupancy, to development over time. And then choosing whether or not you're on a transportation node that's more regional in basis rather than a tube system changes how people will locate as well, which is going to have an impact on residential real estate, which as well, like Mark, we love resi real estate. I think structurally we don't have enough, and people have more tendency to rent than own versus the past. So there's a lot of benefits there. Some of the sectors we like a lot outside of this big picture concept on work from home. And I will say we're not big fans of office at current prices. So I'll add that as well. Office is often expensive. There are differences regionally, but generally expensive. What we like a lot is self-storage. We've been big fans of self-storage for a very long time. It's one of those asset classes that is institutionalizing slowly, and the yield is much too high versus the growth prospects, or said differently, there's outsized returns. An asset class we like is student housing as well. Near term, it's extremely binary. So I agree with everything Mark has said. If I could close my eyes entering at today's values, I think I'm going to do better than average versus all other real estate classes. But it's accepting that there might be a very difficult conversation at year end with one's boss explaining challenges to returns because the kids didn't come to school in October. So that's your binary element near term. We love healthcare as well in all its forms. So medical office buildings, so where you can have a triple net lease for the very long term. Those come in at yields or total returns that are very good. Senior housing is a category over time that hopefully developers won't kill. And what I mean by that, everyone knows about the demographics. So there's a risk, of course, that there's more supply than demand, even if the demand is going to be enormous. But in big picture perspective, we like healthcare as well.
Okay, great. Well, thank you very much. I think that's come to the end of our time. Andrew, did you have any final questions for our panelists?
Yeah, I've got one quick one for you guys. As your big mission is to sort of forecast the future and predict those trends. And how I'm just interested in how you're coping with this huge uncertainty we have around the vaccine issue, about when we get a vaccine, because that just transforms the whole environment. I mean, are you having just huge fan charts, kind of like we see out of the Bank of England, which are almost so wide and ridiculous? Do you have a number of different scenarios? I'm just interested in how you're, on a day-to-day basis, the two of you are dealing with that particular issue.
I'll jump in really quick. So the way we've thought about this is looking at near-term cash flows and a reasonable return to normal cash flows post-vaccine, and gauging what it would mean for value destruction. So if you assume, I'll go to an extreme, you assume no lodging cash flows in 2020, which is not necessarily crazy, by the way. It's a high operating leverage business. So, and then you assume some form of ramp next year, you can build a bad return to COVID when it's cold again this winter. So you calculate that, you assume some return over time. We think it takes 5 years, by the way, for lodging to return to 2019 numbers. So the ramp will be fairly long. So you take your lost cash flows, you assume changes for the long term, and lodging, we think that the work from home movement reduces your long-term cash flows a little bit. And you have a number for by how much should asset values have changed. And then you trade on that, basically.
Great. Thank you, Cedrik.
And I think from our perspective, taking a slightly different tack from that, so we build everything from economic forecasts. Our economic forecasters tell us that numbers are going to be difficult to get right. So it's all about scenarios. We do forecast total return numbers for the different parts of the world and different parts of the market. But I guess we're saying what's important and what's always important, I guess. But relativities, it's the relativities of how those numbers come out in forecasts that are important rather than the numbers themselves, and having conviction on the mega trends such as demographics that haven't changed, such as structural change to retail, which hasn't changed, and trying to make sure that we don't pay too close attention to individual numbers, but more about the relativities of those numbers.
Correct.
Right.
Yeah, that's basically what we do as well. And what I described and gets traded on a relative basis. We're from the same school of thought here.
It's an impossible situation. But thank you. Thank you very much. And thank you, Tom, for a great moderation.
No, well, thank you, Andrew. And I'll be heading over to our CMS booth now if anyone wants to join me there. So thank you, Mark. Thank you, Cedrik, for your time today.
Thank you very much.
Thank you.